Hi, this is Randy Finney with Right Side of the Chart, and today is Tuesday, May 3rd, 2022. It is 1:25 p.m. Eastern Time as I'm starting the video, and what I'm going to do in this one is an update on the equity markets. Start out here on the longest term charts. That's a monthly, pretty much a longest term view I look at. Sometimes I'll go to quarter yearly, but when you go to a monthly chart, that means every candlestick is 1 month of trading history. So you can see the history of the S&P 500 here going back for decades, all the bull and bear markets within. And most significant things on that chart, and this is again a recap, I'll be very quick on this one. We still have the PPO solidly in bearish territory with the bearish crossover. That's when the PPO line crosses down below the signal line. That means the blue line crosses below the white line, and that's represented in the histogram. The farther apart those lines are, the deeper red the bars will be when it's in a bearish posture, and the farther apart they are, the higher the bars will be on green on the histogram behind there. And the takeaway from that is every single one of the big double-digit corrections or bear markets going back for many decades has been associated with those with the PPO crossing over, even if it was a short, quick, 15%, 20, 36. You can see that there. So that one's still in bearish territory, telling us that the correction may or may not be over, that this may or may not be early stage bear market action, because remember, all bear markets start with a cross from green to red, and then that's where they really separate. Like back here in 2007, market peaked in October '07 right there. Histogram crossed over, had a bear market rally up to that point, and then the big drop came. Now, so that one, while still bearish, what I'm waiting for, and I told you we wouldn't get last month, we parked right on, perfectly on this, one of my favorite indicators here, the 20-month exponential moving average, which just does a great job of defining bull and bear trends. COVID, we had that, was the last time we took it out, and that was associated with a 36% drop from high to low, but we regained it the next month, thanks to the Fed and DC, both with fiscal and monetary stimulus, biggest we've ever seen in the history of the financial markets. So that kind of reverted what would have almost certainly been a much prolonged and deeper bear market, and gave us all this, a little excessive stimulus. And that's it. So 1, 2, 3 months we've successfully tested and held that level. And so this month we're early on, so let's not even put too much into this until the month is over. Big level to me is still about that 427 level. And before I leave that S&P, let me just show you QQQ. So QQQ, we did get the first close. And remember, on the Qs, they were stronger back when COVID hit. So when COVID hit, we had a lesser drop than the S&P 500. It was only 31% from high to low versus the S&P's 36. And the NASDAQ 100 closed the month back above the 20 months. So it never even gave you a sell signal back then. It's done a great job of coming and testing it and then bouncing off there. But this time, last month, we had a solid close below. So it's a mixed bag. Remember, the NASDAQ 100, although it's a great index to trade, you're going to get more bang for your buck than the S&P 500 when you get the directional call in the market right. However, it's not the stock market. It lacks certain sectors such as financials and a lot of steady Eddie dividend paying stocks, defensive issues, things like that. It's more of a growth index, if you will, because of the heavy weighting in tech. So that's it. That one's still, that PPO is still in bearish territory. But remember, all bottoms will end with it still red. If you wait for a green cross, a lot of times the correction is well behind us, or the bear market is well over. But so that's it. Those are the levels to watch there on the monthly chart. And again, early in the month, so I'm not going to spend any more time. We'll see how the month ends. Weekly chart, we have, that's not a divergence line. I'm going to remove that because we don't, oh yeah, I'm sorry. It is a divergence line. We do have RSI divergence now on the NASDAQ 100. No PPO divergence. PPO on the weekly chart here still aiming lower, pointing lower, and we're close but not all the way to my second target yet, which is 299, call it maybe 300, after the first target was hit way back here. Ooh, move that. No, I didn't want to move that line. That messes things up. I wanted to leave that target there for future reference. Doesn't matter. It's still, we'll just move the line up right. Well, I'm just going to leave it there. Sorry guys, I dragged it. I just wanted to leave it where it was. Too late. Anywho, there's the 200-day moving averages, another key set of moving averages. That blue line up top is a 200-day simple. We had a breakdown, a back test with a rejection there. Here you can see it much better, I know, in the video when I zoom in like that. Breakdown, back test, big drop, another test and rejection, 2 weeks. Both candles tested it, and then a rejection, and we remain below it, and that in itself is another a bearish indicator for the Nasdaq 100. We could take it back, but to do so, and once we do, that's going to be a quite bullish event if it happens. But you get about you're going to have to rally about 16% to do it. And so again, my theme for this week, remember the Friday post was D-Day, and then I said, well, it's going to be D-Week, because if nothing's going to happen big on a Friday, and we were too close, we were still above the monthly, that 20-month moving average I covered on the SPY. So I said it's really going to be about this week. I think will continue to be what I call D-Week, the pivotal week, a major battle between bulls and bears. If the bulls can successfully defend these levels, they're really shaping up some bullish developments. And like I told you, it might be prudent to pivot if we don't get what we need to see for the bears. I always say support is support until and unless broken. So that's where we're at right now. And actually, we've broken it, but only on a daily basis. I'm about to get to that, but then we recovered it. So the market tends to go in these holding patterns before a couple things, before the big FANG earnings, which are now out of the way, and also before big FOMC meetings. I still think we'll see some last minute selling up until the meeting. So far, we've had a drift up last couple of days, and that's just positive bullish divergences on the very short term charts. But there's some levels I want to show you that I think are important to watch there as well. And then also some considerations on those levels, because we're right now, when I get down to the 60-minute charts and 10-minute charts, you're going to see we have some key trend lines that we're starting to, markets are trying to crack above. I'll get to that one second and then tell you what my thoughts are there. So that's it, weekly chart, and then S&P 500 also still well below the 200-day moving averages. Again, I'll need to zoom in for you. There are tried there, rejected below those. But from this point of view, we have a big level here at about 415.50. It was support back all along here. We tested it several times right here on the weekly chart and successfully held it. Last week we closed slightly below it, and that is a close below, but this week so far we're above it. Now this is intra-week. The one guarantee I'm going to give you right now, I'll give you very few guarantees in trading and investing, but one of those guarantees is a lot can and will happen before the end of this week. So let's see what the Fed says. If whatever it's not about what they do. We know 50 basis points is baked in the cake. The Fed of today does anything but surprise the market. In fact, I think to their detriment, they're almost too transparent, and then they end up backpedaling. And they pledged, like they did this time around, they weren't going to raise rates until well into 2023. Well, obviously that didn't work. Anywho, but this time around, they're not going to surprise the market. We're going to get our 50 basis points, and then it's all going to be about what they say. Are they going to imply that they're going to be a little more hawkish or dovish going forward? And that's what the market will try to digest. And again, at the end of the day, even if they come out hawkish or dovish, most important thing is price action, what the market does after that. And I'm not talking at 2 o'clock or 2:01 p.m. I'm not talking at 2:30 when Powell starts to talk. I'm not talking even at 3 o'clock. I'm talking by the end of this week. We should have a good idea which way things are going to go. And so let's go one more index, and that would be the IWM. We're just going to look at those big three I like to trade and track. NASDAQ 100, S&P 500, and Russell 2000 had this multi-year trading range, well, year and several months there, about just over a year. Broke down there, went in this trading range, and we're below it right there. So we did crack support, but we're holding up right now, and that's because the S&P 500 and NASDAQ are holding up. So the NASDAQ, the IWM broke that level. But again, everything's in a holding pattern right now, it appears, because of the Fed being on deck. Now let's walk down to the daily charts. This is the most important thing I want to tell you. I've been monitoring this and talking about it, but these things are firming up. And again, it bears repeating. So no matter how bearish I may have been a week ago, or may still be, positioned short with swing shorts, I told you, and I did it before. I pivoted back here last time we had these divergent lows. Divergent lows are a huge part of my trading. And they are, you ignore them at your own peril, whether it's bearish or negative divergences during an uptrend like this one here, or whether they're positive, aka bullish divergences. So last time around, we had a divergent low, and the markets had a big rally, one of the biggest rallies in months, right? And but what happened, unlike previous divergent lows, particularly on the daily chart, we haven't seen that in a long time. Usually I'm looking for them on the 60-minute chart, and they did show through on the 60-minute chart as well there, and they played out for that rally. But what was different this time around is it failed these divergences, especially considering they were on the daily chart at this point there and there. They failed to carry the markets up to new highs like they'd done in the past. And so a little bit of a change of character. However, those divergences that started that rally, they're still there, and they're not only still there, they're bigger. The same divergences, because they start at the same point. They start at this point here, and that is prices making lower lows, and the indicators now making, this is now the divergence line. You just take and pull it. So there it is. It is still very much intact. It's not confirmed. I like to see a bullish crossover. That's just me. And then I call it confirmed because you've effectively then put in a higher low. But if that's why this is D-Day to me. If whatever the Fed is selling, the market likes, and we can do this, and we can start taking out each of these resistance levels overhead, particularly these 200-day moving averages right there, 200 simple, and that big level. I think that was still a big level and is about 4. Yeah, I'm gonna move that line up right now, guys. I'm gonna put it right here because we have these two candles there, the top of those candles, and I'm just seeing more reactions there, a lot of candles there, a lot right there. That's definitely where the line should be. There's my magic, not line in the sand, but some severe damage will be done to the bearish case if we can take that out with conviction. That means a solid move, solid daily close above, especially 2-3 green candles, and that number is 428.64. However, nothing to me would be more bearish than to just see the markets go down hard and take out these divergences without them playing out for a decent rally. So that's why to me it's D-Day week, or D week, whatever you want to call it. Big battle between the bulls and the bears. Bears need to foil this beautiful looking setup for the bulls, and the bulls need to capitalize on that beautiful looking setup. Simple enough, right? QQQ, that's not QQQ, this is QQQ, same thing. Here's your divergences. Let me grab my line tool here, make the width a little wider so it shows a little better. Here we go. Positive divergence right there, starting there to that point. And that's where the rally was sparked. That was our divergent low, and that same divergence has only grown larger. Now we've also had, I had a yellow line here. Those are the most significant levels nearby. I'll color them up yellow. And we took it out, but we popped above it. I don't read too much into this because this is a Fed week, right? We took it out last week with the fangs, and at the time, hey, we took it out. Now, give it a breakdown was a breakdown, but look, we recovered it. So guess what? Guess who wins today? You know how I do those little play-by-play calls? Bulls win today, especially if they can close back above there. But just like this has to be taken with a little bit of grain of salt, especially now. The breakdown's been undone. So if you want, you can go long right now. I can tell you that's subjective, but too much in front of the Fed, to be too long, aggressively long, or too aggressively short, it's a crapshoot because the market is prone. I've been doing this a long time in breakouts, whether they're breakdowns to the downside, triggering a short entry, or a breakout to the upside, have a much higher rate of failing when they occur right before major market moving events, such as a big earnings report from one of the big fangs, or multiple. They all tend to report around the same time, and or a potentially market moving Fed meeting. So there it is. I can just say again, without mixing words, this is Back here I was saying this is the most bullish setup I've seen in months, if not years. I said that repeatedly back then, and it proved to lead to a big rally. This is even a more bullish setup, a magnitude of more bullish, because the divergences are much larger, and now we had a little false breakdown, a whipsaw, and a recovery back above that level. That's aka bear trap, right? But again, you got to put a little question mark here. I think we'll see some nervous selling in front of the Fed, is my guess. Do what you want, but I think the big fireworks are going to start after tomorrow. And again, it's simple. What I told you, we can start moving up here. A big comparable level to what I just give you on SPY would be about right here. Those are those same comparable candles. The recent highs. We had a little trading range here. That's about 330 on QQQ. Ideally for the bears, you want to see it stay below there. And again, the bears need to take out that divergence right there by taking us down, getting back below 317 and staying below 317, right? And then if so, that should open the door to my next targets, which I still favor at this point in time. But again, for me to sit here and just deny or not mention these divergences to you and what they could mean, I wouldn't be doing my job. So trade as you want. Again, if there wasn't a Fed meeting, I'd say, man, this is pretty bullish right now. You might want to start layering into some longs, and you might, but and if you do, then just look, it's pretty simple. Look, we're not that far off the lows. Take a long position, set your stop below the recent lows, or depending on where you think. If you think the market's going to new highs, my goodness, you've got 27% just to get and test that high. So you could give yourself a 10% stop loss and have nearly a 3-to-1 risk reward ratio. So you could give yourself plenty of room. So that's why I always say stops are really commensurate with what you're targeting. If you're only targeting a quick bounce up, if you're bullish, and likewise if you're bearish, my next target on the downside isn't too far below. We came very close. I'm not going to say it's effectively hit because we're a little north of it. We were at the recent low on QQQ was 309.64 versus a target of 299 to 300. Close, but no cigar. So we're still only hit T1, T2 still pending, and we'll have more clarity. Hopefully, should have more clarity after the Fed's out of the way tomorrow afternoon. All right, back to the daily chart. So I showed you S&P 500, strong positive divergence, yet to be confirmed. QQQ, positive divergence, same story, and then IWM. So pretty much every index. If I did the mid caps, you're going to probably see the same thing there. That's it. So we had, just like QQQ, you had a recent double bottom low. We broke it. IWM hasn't yet clearly regained it. It's starting to pop its head above it. Right there, it's I extended. I made the line yellow right here. It's up to about 191, but the same story. If the markets can hold and build on these gains into, and especially after the FOMC announcement, then you're going to see this divergence here confirmed, and that's going to be pretty darn bullish. So again, have to recognize that and tell you that if you are short at this point in time or looking to hit those downside targets I laid out, I think they'll be hit, but then it just might push off to later this year if this rally plays out, or possibly even next year. Who knows? And again, if we crap out, the thing is, I believe, because I think it's a major battle, I'm not trying to be dramatic with the whole D-Day thing, just telling you how important these levels are in my head, or from my experience, that if this bullish setup craps out and the bulls fail to capitalize on such a beautiful setup, then I think it'll be a quick ride down to my targets. And then what does that mean, a quick ride down? My next stop on IWM from where we're at now, T2 is about almost 10% below. T3, if hit, is almost 16%, and T4 is almost 24%. And that could be a very swift ride down there. If we do head up, I don't think it'll be as swift. Stocks tend to fall faster than they rise. Just look at any other bear market, any period in time where you had a bear market or a significant correction. The thing is, the market has a lot of overhead resistance. You're going to see almost guaranteed, if we get there and we test the 200 days, if we test this big 209 level in IWM, you'll probably, at least on the initial tag, see some sellers step in And so there's a lot of overhead resistance, where on IWM there's really not a lot of support, because this was a thin zone here. Let me show you what I mean by a thin zone. Volume price histogram will show you where stocks have traded, where the volume has been at each price. And so it's a lot like, if you have a gap, you're not going to have any bars on a volume price histogram. This was not exactly a gap, but comparable, because you had resistance here. IWM had been capping out around this level and had a breakout, and just in a matter of weeks cleared that area. So there's a big thin zone. Usually once you enter these thin zones, and that is, again, if you're not tracking, it's this right here, these two short bars all the way down to this is your thin zone. And that's why not why, but it's not coincidence, my target lines up there, T2. Thin zones, once entered, just like a gap, are typically backfilled, and they're usually backfilled relatively quickly. So we either snap back up, and then this proved to be a false breakdown and the divergences play out, or they crap out. So if you are faint of heart, somewhat risk adverse, I always say that's an oxymoron for a trader to be risk adverse, but maybe you're an investor and that's why you're here, not for the active trading stuff, but for the investing stuff, then you might want to keep things light and let the bulls and bears duke it out here, and then step in after a clear winner has emerged. Okay, so that's it. Daily chart, divergences across the board need to be confirmed. Now let's just quickly look at the sectors, and then, no, stay on the indexes. Why don't we do that, since I'm already on the indexes? IWM 60-minute chart, one of my favorite time frames. Positive divergence. Okay, you got to respect these divergences. They don't always play out, but they often do, whether they're positive, aka bullish. That one played out for a rally from that point before all was said and done, was about a 13% rally. And then we had negative divergence, and there it is on the indicators. That played out for a drop of 14%. So this is my favorite swing trading, or typical swing trading time frame. Swing these divergent lows, swing these divergent highs, divergent low. So again, that you don't always have the same divergences. It's not the same points either. It's different divergence, but we have divergence on the 60-minute charts. And again, just to loop back to what happened the last time we had 60-minute divergence, it failed to play out for a move to new highs, which was a change of character in the market, and they faded 100% plus, all and then some. Oh, the breakout was right there, but even from that divergent low, we went to new lows. And again, that's indicative of that's indicative of a bear market rally right there. That was just the SPY chart, but the QQQ did it as well. All right, so back to that 60-minute chart. This is QQQ. We've had divergence building. Again, it was there on the daily chart I showed you. This was the wedge right here. We broke out. That ended with a divergent high right there, and one of the, highlighted again is a very objective shorting op. That was also a test and failure at the 200-day moving average. We moved down, but you can see we've been building divergence. In fact, just like on the daily chart, really it's this divergence from here to here, but we have it even starting to steepen up here on the indicators down below as well. So there's divergences across the board, guys, and divergence, as if I haven't said it enough times. And it's something to be respected, and something to, I think, jump on pretty aggressively. If it fails to materialize, we take another leg down. That will tell me almost for certain we're in early stage bear market action. Remember, the S&P 500, although the NASDAQ 100 has already dropped over 22% from high to low, and it's down currently about 20% or give or take. The S&P is only down 13. So the media, we're not in a bear market. We're not in a bear market by the media's metric, nor my own. All I'm looking for, as I've told you many times, I'm looking for pullbacks to the primary bull market uptrend lines in these indexes. This is it right here on the NASDAQ 100, all the way from the lows back in 08, 09 in this yellow line. So if we get that, they will tell you, and we will be in a bear market then, but to me that's just a bull market correction. That's where I'm targeting at this point. If we get there, I'll be looking most likely for a bounce, especially if it coincides with one of my targets. But guess what's going to change? What's going to be different, right? If we hit that bull market uptrend line, where I'm sure buyers will step in because it's very obvious, we're also going to have clearly taken out that 20-month exponential moving average. So I think that's what it'll be, is something like that. And then remember, we took it out on QQQ, but not by a lot. We're just below it or close to it right now. SPY, we need to take it out. And so that will be likely, to hit the bear market uptrend line. Here's one on SPY as well. Let me thicken it up so you can see it better. Color it blue. There's a comparable uptrend line on the S&P 500. Probably get a bear market rally there, and then short a kickback to the 20-month from below if we get it. Again, if that scenario plays out. Otherwise, here we are. We're on the 20-month. Bulls buy it here. Stop below. But on the 20-month, problem with buying it just because you're buying the pullbacks to the 20-month, and if you're going to use that as your only entry and exit criteria, which I wouldn't, the reason I wouldn't, when you take it out, it's usually a very big, fast, candle. And if you wait to the end of the month, today is May 3rd, you got almost the entire month to go. I mean, you'll almost very likely already be at my second, third, or maybe even fourth targets by the time you get there if we do. All right, back to the cover. All right, so that's it, I think. 60-minute charts, QQQ, yep. All right, I want to show you the NASDAQ 100, what I've been trading lately. I'm going to center this chart. I think I got these out to you yesterday. Big trend line here right now on the NQ futures. This is the, I'm using a 10-minute. A lot of times, I'll trade multiple time frames, sometimes a 5-minute chart, sometimes a 10, 15, 30. It all depends. This is a 10-minute chart. It shows me really what I need to see up close. I have a trend line here from, what was that, April 21st right there. This downtrend line has a lot of touches, and we just popped it today. So we have 1, 2, 3. I like the fact those are very distinct and clean reactions with impulsive rejections off. We've been tapping on it lately. We tried to pop it today, but there's also some price resistance there, what I call BOD, benefit of the doubt. And you also, at this point, since we just took it out, you now have divergence. And if you go a little higher, you're going to have divergence. So we're starting to diverge here now, negative divergence. Remember, we just came off this divergent low the other day, positive divergence. Again, 10-minute chart, active trading stuff. And so I don't think this breakout's going to go too far if it happens. Again, it already happened if you zoom in tight enough, but we're right in front of the Fed. So I think you're going to see some nervous profit taking. That would be my guess. Take it if you want. Maybe it plays out. If you take it, you just like any other breakout. If breakout fails, you stop out. Take the breakout, but I wouldn't. I'd rather short it, which I did today. Been long short last few days. I gave you that. I think, yeah, I did. I gave you one of the active trade setups today. The first time we hit it, pull back to right here. That was where my arrows were drawn, and it was it. We pulled back right to that 12,981.50 support level. Here, you got to zoom in to see it. And that's just active trading stuff. There it is. So you hit the trend line, boom, had a pull back to that level, hit it again, boom, pulled back. Oh, no, the second time. There was the pullback right there. 2 pullbacks to that level, I should say. And now just above it, but right at that previous reaction high. And here's what, and again, divergence lines, I just take these now and I extend them. And if we exceed these previous highs right here and here, then you've taken out the divergence. But as of now, we do have negative divergence because we're slightly above that previous high as well. Even if we just equaled it and the indicators are making lower highs, that's still negative divergence. That's the NASDAQ 100. And by the way, that shows through. You can also look at it and see it on a 60-minute chart, which I just flipped to. This is the same downtrend line right there. There's your downtrend line. There's your positive divergence. It's been building for a while. Okay, so that, again, what I've been saying now since last week, the ball is in the bulls' court, or bears' court, however you want to look at it. Bulls need to capitalize on this bullish setup, break it out. Buyers need to step in and take it up. If you do, pretty big resistance up here. Yellow lines were, I had those yellow lines here and here at 14, 294 and 13, 693. I had those marked back here yellow because they represented this trading range, and I told you I favored a break to the downside, and if we got it, that would trigger the next drop, which it did. There was a breakdown back test of it, so it's still an important level. The bulls come back up, as are pretty much all these lines. These are my resistance lines, and the way it works is, if and as each resistance level is taken out, especially the yellow lines, then that's bullish, especially if they can hold those gains after the FOMC meeting. So that's that. S&P 500 ES, we're on a 1 month hourly, same chart, 60-minute chart as I was just on NQ, same trend line, same thing, a lot of clean distinct reactions starting back there, 2 3 4, and now we're testing it right now. And I favor a rejection here, and even if we get rejected, there's still divergence. Even if we took out and made another low, but here's the thing, keep making these divergent lows, we're walking down, we're not too far from my next targets on the weekly. So all right, levels to watch, and if we pop it, this would be my BOD level. I always refer to that, I call it benefit of the doubt resistance, and that's when I have two resistance levels in close proximity and I'm looking for a bullish breakout or bullish setup. I'll give the benefit of the doubt to the latter of the two. Why? Because some traders are looking at the trend line, they're going to take that breakout, but then other traders are looking at that 4,200 price resistance on ES, and they may step in and sell there. So that's the safe bet, not the break of the trend line. You want to see 4,200 get taken out. Again, is it a breakout I'm going to take because of the Fed? No. In fact, I'm shorting it, expecting a failure there or at the BOD level, and probably another pullback. I think we'll probably get another down like that, pretty deeper down, where you can maybe short here today around these highs where we're at right now and just sit tight until after the FOMC meeting with stops in place. You can either have stops above that recent high, any of these levels. You can trail stops down. There's 101 ways to trade. And then finally, last but not least, I've been going over the pretty down to the short-term time frame there on the stock index futures, and let me just go rifle through the 11 sectors of the S&P 500, because as I like to say, any index is simply a sum of its parts. With the S&P 500, there's 500 companies. Sometimes I do go through, not all, but a lot of the charts, the top ones. I'll sit there and rifle through hundreds of charts in any given day. But we're not going to do that in this video. You'd be listening to me talk for hours. We're going to go to the 11 sectors that make up the S&P 500. And I'm just showing you the common theme here. A lot of these, and remember, as I do this, very important, as I do this, I'm going through these sectors because I have them on my watch list in descending order of weighting, with the tech sector right here, XLK, Spider's technology ETF, is a better, and I haven't updated this recently, it changes time to time, so don't hold these numbers. Probably did this a few months back. Every now and then I'll go in and update it, but over 25%, so over a quarter of the S&P 500 is weighted in technology, where over half in the NASDAQ 100 is tech. So this is by far the most important sector. And no coincidence, this chart almost mirrors, at all times, it's going to mirror the NASDAQ 100 because of its heavy tech weighting. Most important developments, we had a divergent low there. We got a heck of a rally out of it, but it also failed to take out key levels that I talked about and got rejected at those levels, price resistance in the 200. But that divergence is now even larger. And although there is no set formula nor any guarantees, all I can say is that typically, not always, but typically, the larger the divergence, the larger the rally. So if we got, at that time, which we did, a rally off that divergent low of 16%, then by that logic, one would assume that we could, this could be the catalyst to run up and test those old highs and possibly even break them. If anything's going to do it, this is it. So again, I know I keep saying the same thing, but this is a beautiful setup for the bulls. It has everything and then some, not just divergences, but it also has the potential for a whipsaw here. We just recently cracked those recent lows to recover back there. That's a bear trap. What that does is when you break support levels, especially well watched, everybody's been watching the recent lows on the NASDAQ 100. When you break that but then recover it, that's what they call a bear trap. It's called a bear trap because short sellers will short into the breakdown, and then when the breakdown fails, meaning you get back above it, all of a sudden those shorts realize they're wrong and they have to cover. Their stop loss orders are getting hit. They're going underwater, and then longs will step in when they realize, oh, the support actually held. And then you have the predatory longs, like me in many cases, which will take advantage of the short's pain, smelling a short squeeze and jumping in on that to exacerbate the buying. So we'll see. That's and also a downtrend line right there I gave you, and then you've got that price resistance up here about 147, 150. All right, so that's it. Look at that divergence, just ready to be confirmed or rejected. So we'll see. A couple less than 24 hours. Right now it's 2 p.m. So yep, exactly 24 hours from now we'll know the decision and they release the initial comments, and then Powell will get up there and do his dog and pony show answering questions from the press. XLV, nothing big, or nothing major to report. This is the shaded box. When you see these shaded boxes in yellow levels, that's the big level, 124. So this one's comfortably above a support level that will, send it much lower. Still looks very toppy. This was a major divergent high. We've been diverging since back here. Negative divergence since that point. It's not like the negative divergence didn't play out. Played out for big corrections. Bigger divergent high, bigger drop. Even bigger divergent high, what I think will be even a bigger drop, and then finally break that level. That's what the bears need to do for healthcare sector, second largest. XLF, financials. Again, you have my box here, and this is just like so many indexes and sectors where it's a year-long, some cases over a year-long sideways trading range, topping like pattern. Broke down recently, but it's back testing. See that red line? It's at 35.33. It's a big support level. It was resistance here, resistance, broke out to new all-time highs, successfully back tested it once, twice, 3 times, almost there, 4 times, 5 times, 6 times, and finally broke it. So that's a major breakdown. However, it's a breakdown with positive divergence. Wish I didn't see that. I would feel so much better on the shorts. And look, guys, I haven't pivoted yet. I'm still short, still expecting the downside, but I would be a lot shorter or a lot more comfortable with holding on to those shorts and not talking about pivoting if I didn't see all these divergences. So I expect the divergences will crap out because I believe we're in early stage bear market action. But if they don't, it's just not that time yet. That time will come. It's going to come later down the road. Sorry if I just adjusted the mic boom. I realized my mic boom had moved down. Hopefully you could hear me in the last few minutes. All right, so that's it. Big level. See? Breakdown, back test. And it is an objective short, but again, in front of the Fed, and the fact that the S&P and NASDAQ, some other indexes and sectors have taken back the breakdowns recently, you just might want to keep things a little light for the next 24 hours at least, and then jump in hard if whether you're bullish or bearish. If the bears win D-Day, D-Week, I plan to be very heavy short, and if the bulls win it, no, I will start scaling out or flip quickly. We'll see. We'll see what happens. I'll look at everything. Again, it's not any one. I wish I could tell you there was one chart or one level or one index. It's a combination of everything. Key stocks, key sectors, what treasury bonds are doing. A lot of other things go into my analysis just for trading the equity indexes. All right, but these are levels to watch. 35, roughly 35, 33. And of course, if we get rejected there, you have my next target here, 32.83, and then 31.35. And I still go back to the weekly charts. I think those targets will likely be hit. It's just a matter, are they going to be hit very soon or a little later down the road? Next up, XLC communication sector. This is at least last time I checked, the 4th largest weighted component. Now we're down to about 10.6. So as big as these companies are, their weighting is less than half of what the tech sector is. And they're considered tech stocks, but they're in that communications sector. That's how they're lumped. And that's Facebook, aka Meta, and then Alphabet, aka Google. And it's funny how these companies change their names like that over the years. But there's your downtrend line. There's your divergence. Still in place clearly on the RSI. Slightly taken out here on the PPO. But And there's a good example of divergences. Let's just look at Facebook. I didn't plan to go over individual stocks. I'm going to finish the sectors. Heading into earnings, the one stock I told you about was the most bullish. If I had to go long or short and roll that dice into earnings, it would definitely be long. And you can see what a divergence, what it did. It wasn't confirmed at the time, but it has since become confirmed. And even if this is it, which I think it is for now, I gave you a target up there of 212.21, and that's been hit. We hit it actually 3 days ago. We hit it again yesterday, and we're trading on it right now. So that's giving you 3 days to take profits if you took it. Most of the move came on the pop, overnight and into after hours. But again, this was the divergence that I was highlighting. We had strong positive divergence, deeply oversold, and that can lead to these quick moves up. And so far it's been about a 25, I think. Yeah, 25, 26% pop in Facebook, but right into resistance. And, make no mistake about it. I know that's bullish, but what it is, at this point in time at least, nothing more than a bear market rally. And that's why I love bear markets. It's not just because I like shorting. I love even more than that. I love trading bear market rallies. I'm trying to get rid of that those fibs. I'll do that later. I was trying to find a clean board and just put up Fibonacci retracements and show you that here's the drop from high to low. This is a 38.2% fib all the way there. If I add on the lowest, the minimum fibs of 23.6, that's a minimum retracement. We're not even there yet. Close to that, but not even to the 23.6 retracement yet. So make no mistake about it. That 25% move in Facebook, if you're thinking, oh my gosh, that can only mean that the bear market in Facebook is over. No, it doesn't mean anything more than the fact it's just a bear market rally at this point in time. Okay, we're almost done. In a long video because I've gone over a lot here. XLY, consumer discretionary, also made a slightly lower low, holding big support. I've had this yellow line here for a while, 161.50. We slightly, I wouldn't even call that a breakdown because it was intraday, but it did give us a divergent low. We made a slightly lower low. We've had multiple tests, and again, this is why I look at everything. Here's a key sector. So far, bulls are holding the line, and if they can continue to hold the line and build on and get away from it, they're going to confirm this positive divergence. If they break that support, all I can tell you, it's a big support level, and the bottom will probably fall out of that sector. XLI, industrials. See, common theme here. These are the industrials right here. We've been diverging. We had positive divergence there. Right there, and the divergence has only grown larger with, again, you got it, another marginal new low. If anything, this should be the yellow line right now. But again, this has been a progression. To me, it's early stage bear market action. We already took out, this was my yellow line before. We had about a year-long trading range there, put in a divergent high, had a little whipsaw, but then we broke it and we're below it. But now, since we've had multiple tests there, that's the next yellow level. This is the next check mark for the bears if taken out. And this is also, right now, a check mark for the bulls as long as they hold above. And they tested it and they bounced. Bulls' next check mark comes if they take back 97.80. So that's how it works, all right? And I could go through the rest. You're going to see most of the same things. And these guys don't move the needle. XLE, I gave you that as a short trade idea. In fact, I've highlighted about a half dozen sectors in recent months, and they're all outperforming the market to the downside. So if you shorted any of those, that's the home builders, the semiconductors, financials, and just recently I put on this short right here on the breakdown of this wedge. We hit my first target, as is often the case. We bounced on the initial tag of that target, and we'll probably go on down next, have another leg down, hit my second target, probably bounce from there, and then ultimately go down and hit my third target. Okay, I'm going to wrap it up here. Long video, but now you know the levels I'm watching, what I'm watching, and also what to expect between now and tomorrow, which is probably a lot of back and forth volatility. And again, I would take any breakouts, even on those short-term time frames, with more and more of a grain of salt over the next 24 hours because you're going to start to see algos firing off trading programs. You're going to see investors, both institutional and individual investors, position squaring, hedging, taking profits on longs if they're profitable, covering shorts if they're profitable, or losses. In other words, just kind of reducing, just shuffling positions, let's just say, in front of the FOMC. Some people are taking positions based on what they think is going to happen. So it just leads to a lot of this aimless kind of stuff. So maybe keep it light until tomorrow, but you have levels to watch. If you want to trade actively, I give you that 60-minute and even 10-minute charts, and have at it. They've been working very well lately. All right, we're going to wrap it up here. This has been Randy Finney with Right Side of the Chart. Have a great day.